Since 2021, the only thing that's really worked is when the probability of a hard landing goes down dramatically. If you raise cash, that's been the right thing to do because we've had th two or three instances now since 21 where the probability of a hard landing goes up a lot. And there's a theory that if they don't get interest rates down, then it's gonna right now interest is $1 trillion per year. It's greater than defense spending. In interest as a percentage of tax receipts is like near 20%, which is in a very, very wacky, lunatic danger zone. The rest of the world is nowhere near that. And so a lot of clients think that we need to get rates down, and that's why Powell cut rates 100 basis points, even though the economy, all the GDP indicators back then were actually very, very healthy, and we were cutting rates 100 basis points. So the point of our book, How to Listen When Markets Speak, comes down to financial repression. The only way you can get out of a 36, $38 trillion debt hole without default is to get interest rates below the rate of inflation. Get interest rates below the rate of inflation, and then you can inflate your way up. The problem is if you go into recession and tax receipts fall, then you're in real trouble because then your interest as a percentage of tax receipts starts to really overwhelm the government, and that's when the Fed has to step in and really move into quantitative easing or yield curve control. That would really weaken the dollar, and that would really put you into a massive bull market for commodities and hard assets. So in some ways, they need to slow the economy down, so then cut rates more. And that's what you kind of saw in that January, February, March area. But they can't let it slow down too much. And that's why if you look at the budget, relative to what we were told about all these budget cuts, they're just terrified. And that's why the spending in the budget is still really in the Biden territory. And as long as the budgets are that big, it's very difficult to go into recession.
In a recent post on X, you mentioned Fed Chair Jerome Powell's now notorious statement that he made about a year ago. He said that he sees neither stag nor inflation. And now, when we fast forward a year later, 12 months later, Fed President Neil Kashkari says the question now is the magnitude of stagflation, not whether it will happen, but it's actually how bad is it going to get. So are we truly too far along for things to improve? In other words, how bad do you expect the economic situation here in the United States to get before we see any improvements?
Well, yeah, so the last several years, we've had um, a deterioration where we're going to a regime of higher bond yields, higher inflation, and every time the economy softened, like say the regional bank crisis of 2023, the Fed opened up this incredible facility around basically supporting the bond market. They expanded the balance sheet. They just cut rates 100 basis points. So they've been doing all of these really what we call dovish things that are very, very supportive to keep us out of recession. And it's like they won't take the medicine. The only way you really truly kill inflation, we make a point in the book that I sat down with Andre Estevez in Brazil, and he's the CEO of BTG Pactual, billionaire, probably one of the top investors in all of Latin America. Brilliant man. He's like, Larry, Americans don't understand. Once inflation gets above 6% and is there for at least a year, it's under the seat cushions. It's in the carpets. And they'll knock it down, but everything they do in Washington, unless they really try to kill it with real budget cuts and real lots of rate hikes that stay up there, they're not going to kill it, and it just keeps coming back. It's like a certain it's like a scene from the Terminator. You know, the Terminator keeps
Right.
coming up, keep coming back. Arnold Schwarzenegger, and that's what's been happening since 23. Every time they knock it down a little bit, comes back up. Yeah, so the probability that we're moving into a 1968 to 1980 regime of stagflation, higher interest rates, higher bond yields, elevated inflation, and then some softness in the economy at the same time. That's real stagflation. And the one thing central bankers always remember, central bankers are like the pilot on the airplane when they're losing an engine. All they're going to say is, ladies and gentlemen, stay in your seats, everything's fine. They don't want to panic. And central bankers will never tell you the truth. In 2007, 8, Bernanke said subprime was contained. And it was like 9 months later, we were in the middle of the worst subprime crisis. And so you're going to be very careful. Yeah, so there's a big deterioration, a big movement towards stagflation. Powell's been in denial of this, and now you've got Fed governors admitting it, like you just said. And so that's why investors watching us right now need a totally different portfolio construction than the previous decade.
Do you believe that this might be a beginning of a full-blown default cycle as well, if this is sort of the environment that we're in or we're moving towards?
Well, yes, if you look at the commercial real estate market and you look at the high yield bond market and the investment grade bond market, the good news is a lot of companies were able to refinance debt in 2020, 21 after COVID. And remember, the Fed suppressed the cost of capital. And they did something amazing. The longer that you suppress the cost of capital and don't allow the business cycle to function, the more kind of evil that's under the surface.
Mhm.
And they created all these distortions by holding interest rates really low. It allowed a lot of companies to finance themselves at like 1.5, like 1.75, 2.25. Apple issued a bond. Let me give you an example. Apple issued a 2.55% coupon bond that matures in 2060. So it pays 2.55%. It matures in 2060. Take a guess at when they issued the bond at par at 100. Take a guess where the bond is now. I'll give you a hint. It's in the 50s. So this is a bond that's backed by Apple. It
Right.
was issued at 100. But when the Fed was suppressing rates, right? And the bonds trading down in the 50s. So imagine all the banks own these bonds that were issued with very low coupons, and those bonds are trading in the 50, like 55 cents on the dollar, 53
That's an
cents.
incredible discount, right?
Yeah, incredible. And so now we have these bonds. A lot of the bonds are going to start maturing now. That bond's 2060. That's not maturing. But in the high yield market and in the investment grade market, and especially in commercial real estate, all of this stuff, all those loans that they issued in 2020, 21 are starting to mature. And that's what's going to cause this pretty nasty default cycle. Because imagine if you're a company and the last 4 years, or 3 years, Powell's been telling you that we're going to get rates down, and the Wall Street. Just look at Wall Street. Wall Street told us by now Fed funds rate should have been back down at 2%. We're still up near 4.5. And and so when those bonds mature, those company financing is going to go up a lot in terms of the cost of capital. And yeah, a really nasty default cycle is coming. And question is it mid 26, late 26? I think the Trump team has the midterms. They want to do whatever they can to get through the midterms and avoid this.